Have you been feeling that lately? That weird sense that the headlines are saying one thing about the economy, but your own wallet is telling a totally different story? It just feels tight. Well, you're not imagining it, and the real reason why is probably not what you're thinking. Let's start with the big one. Why are mortgage rates so stubbornly high? We keep hearing that the Fed might cut rates, but for anyone looking to buy a house, it feels like nothing is changing. It's a huge source of frustration, but that's just one piece of the puzzle.
And then there's this, the stock market. One day it's calm, the next it's taking a nosedive for reasons that just feel completely out of left field. It's jittery, it's unnerving. So what in the world connects these two huge, stressful financial problems?
Well, here's the crazy part. The key to understanding your mortgage and the jumpy stock market, it doesn't start with the Fed in Washington, D.C. It starts halfway across the planet, in a place most of us haven't been looking at all. You see, for decades now, Japan has been playing this quiet but unbelievably critical role in the global economy. I want you to think of it like a secret support beam in a building, a hidden piece of the foundation that's been holding up a huge part of the financial world, without anyone really paying attention to it. Or maybe a better analogy is duct tape. For the past 30 years, Japan has basically been the financial world's duct tape. It's been cheap, it's been reliable, and it provided this steady flow of cash that patched up holes and kept the whole system stable.
And you knew there was a catch, right? That incredibly reliable, always there duct tape is starting to lose its stick. The very force that gave us so much stability and so much cheap money is starting to come undone. And we are all just now starting to feel the effects.
So how on earth did one country become the entire world's financial safety net? Well, it all goes back to a huge crisis in Japan, one that accidentally created one of the biggest, most important, and honestly least understood financial trades in history. So here's the quick history. Back in 1992, Japan's giant economic bubble burst, and it sent the country into what everyone now calls the lost decades. For 30 years, its economy basically flatlined. And to fight that, the Bank of Japan did something radical. They slammed interest rates down to zero and just left them there. That one decision, decades ago, set the stage for everything we're dealing with today.
Because that situation with interest rates at zero created this massive, massive opportunity. It's called the yen carry trade, and the idea behind it was just beautifully simple. If you can borrow money for free in one place, why wouldn't you take it somewhere else and make a profit?
So let's make this super simple. An investor, we'll call him Bob, could go and borrow a ton of Japanese yen for basically nothing. Then he'd swap that yen for US dollars and buy a super safe US government bond that was paying, let's say, 4%. And just like that, he gets to pocket the difference. Now, multiply that by billions and billions of dollars. It was like a global free money machine.
And listen, this wasn't some little niche strategy for a handful of hedge funds. We are talking about a trade that, at its height, was worth over $1 trillion. That's a massive, constant river of cheap money flowing out of Japan and pumping up the value of assets all over the globe. The best way to think about it is this. It was like the entire global market was running on Japanese Wi-Fi. It was just always on, humming away in the background, providing the cheap liquidity that powered everything from corporate takeovers to maybe even your own retirement account. You never really noticed it, but you would definitely notice if it suddenly got shut off.
And that is exactly what is happening right now. The one single assumption that this entire trillion-dollar system was built on, the idea that Japanese interest rates would stay at zero forever, well, that assumption just broke. The Wi-Fi just got turned off. This is the moment it all changed. In 2024, after 17 years of keeping rates pinned to the floor, the Bank of Japan finally started raising them. Now, it was a tiny move, but the signal it sent to global markets was like an earthquake. Because the second the Bank of Japan raised rates, the cost of borrowing yen went up. The entire foundation of that bot method we just talked about, it just crumbled. That easy, guaranteed profit, it vanished almost overnight. So when the math doesn't work anymore, the money changes direction. All those investors are now unwinding those trades. They're selling their US stocks, they're selling their bonds, converting the dollars back to yen, and bringing all that cash back home to Japan. It's a process called repatriation, and it's like watching a giant financial tide go out all at once.
Okay, so a bunch of big investors are shuffling money around. Why should you care? Because this isn't just some abstract story for bond traders on Wall Street. This is an everything story that connects directly to your bank account.
Let's just break this down.
All the news, right? It's always focused on the Fed. And as you can see here, they do control short-term rates. But look at the other column, the long-term rates, the ones that actually determine your mortgage. Those are just driven by basic supply and demand for bonds. And for 30 years, Japan was a massive, unwavering source of that demand. Don't just take my word for it. The legendary investor Ray Dalio put it perfectly. He said the bond market is the backbone of everything. Those long-term interest rates are the bedrock that basically sets the price for every other asset out there, from a house to a share of Apple stock. And that bedrock is shifting under our feet. So let's trace the chain reaction here, step by step. It all starts with this. As that huge tide of Japanese money pulls back, they start selling off the US government bonds they've been holding for decades. So one of the biggest, most reliable customers for US debt is suddenly walking away from the table. So what happens when a huge buyer vanishes? It's simple economics. With way less demand from Japan, the US government has to offer a better deal to get new investors to buy its bonds. And what is that better deal? It's a higher interest rate or a higher yield. And there it is. That is the direct line to your wallet. Mortgage rates are tied directly to those long-term government bond yields. So as long as those yields need to stay high to attract new money, your mortgage rate is going to stay stubbornly, frustratingly high, no matter what the Fed decides to do. And it doesn't just stop at mortgages. It hits the stock market too. Think of it like a seesaw. When the yields on safe government bonds go up, they look a lot more attractive compared to risky stocks. That forces stock prices down to try and compete. On top of that, higher rates just make a company's future profits worth less today. It's a double whammy that creates all that volatility we've been feeling. So you see, this simple story we always hear, that one little rate cut from the Fed is going to fix everything, it completely misses this gigantic global shift. For 30 years, the world economy had a private ATM called Japan, an ATM that just endlessly spit out cheap cash. And now, the most important question we all have to ask is, what happens when the